Hello, this is Dave, and welcome to Equity Story. And obviously, this is just general shared advice and not personal. And I've got the amazing Claude Walker with me. And did you have a good weekend, Claude?
I did. It was my friend's birthday, so it was a great weekend.
Can I just ask you a question? Like, what hobbies do you have? Because we're all very interested. Like, I think you analysts are a very special type of people. Now, Wolf on the weekends goes off running around the country looking for rocks, and then he brings them back. He goes all around the outback, and then he polishes his rocks. And I don't know what he's looking for, but he's never found the golden nugget yet that's going to save him and get him out of working for Equity Story. Do you have any hobbies like that, Claude? Or
Not really, no, nothing that unusual. I pretty much just go surfing whenever the waves are right, and if the waves are wrong, then just maybe bushwalking or go for a swim. Like, I love spending time in nature. And then on the weekends we stay in Canberra. That's usually because one of our friends is having a party or something like that. So just a bit of socializing and dancing and that kind of thing.
yeah. Anyway, Canberra. How do you find Canberra? Because every time I go there, it reminds me of one of those sort of cities in the Midwest. Like, there's no one around. It's pretty dead. Is it that bad? No.
I think it's pretty bleak when you don't know Canberra, but I went to university here, so I have a good group of friends, as many friends in Canberra as in Sydney. It just, actually maybe even more. But the difference is, in Sydney, my friends are scattered around the city. It takes an hour of traveling to see anyone. Whereas in Canberra, everybody lives within 15 minutes drive, probably within 20 minutes bike ride. And although the social life's like not as much to offer in terms of various things to see as Sydney, millennials can actually afford houses in Canberra. So, a lot of the group have their own place and
that's the great
have
thing.
Parties and stuff like that. So it's good.
Well, that's the great thing about Canberra, isn't it? You can own your own home. You don't have to be a
it's
multi-billionaire.
It's getting a bit extreme now, but a lot of them have quite solid jobs as well. So the government pays probably pretty well. You're not going to get rich, but you have a good amount of money. So yeah, it's just people my age have an easier time living in Canberra, which means that we have more time for fun.
But you know what I like about it? I often think sometimes when you're an analyst and you're trying to sort of see the world, I think some of the best writers of the UK are people that actually don't live in the UK. So I don't know. I'm interested. Both Wolfie lives in his little mountain place wherever he lives, and you're in the Canberra. Some ways maybe it's easier to see the companies and easier maybe to look at the world when you're a little bit outside it. You're not stuck in the hustle and bustle.
Well, that was Buffett's theory with Omaha for sure, and I think you can too. There was a time in my career when it was really useful for me to go and attend lots of AGMs in person and meet other investors and that kind of thing. So I was grateful for being in Sydney during that period for sure.
All right, now we're going to do something very much more interesting today. We're going to, I'm not saying like it's not always interesting what we do, but I like the idea of what we decided is to look at, 3 stocks that we need to buy in some sort of pullback, or 3 stocks that could be interesting at the right price when the market starts recovering. And I'm pleased to say, like, 2 of those stories you and Mr. Wolf are very much on the same page with. But obviously, I think getting your point of view as well is just gives our members just another. Everyone sees a story slightly different than everyone else. I think it gives people another view on that stock. So we're going to start with these stories one by one. And the first one, I think we'll go with Vista. And it was a little bit topical today. I think one of the brokers came out with a $27 target price on this. I know this is a stock that you follow a lot more than we do, funny enough, at Rich Life rather than Equity Story. I think it's having a run at the moment, and yes, it could go, but this is a story. I think if we can get it around 20 bucks or even 17, maybe we should be having a look at if it gets sold off in a little bit of a market downturn. Can you tell us a little bit more about this, Claude? Because it seems a tremendous growth story. Opening 85 to 135 stores a year. That's one every 3 days. That's crazy.
Yeah. So it's got a good rollout story. It's partly due to the fact that I think that the products that they sell are quite high margin, kind of not that expensive to make. And they can fit a lot of stock of their jewelry stuff in a small store, so it saves on rent in terms of the amount of sort of turnover they can do per dollar of rent. They've got a good advantage there compared to many other retailers. And also broad appeal. I think a lot of men can be slow to realize it, but everybody from a multimillionaire lady might want to buy Lavisa jewelry she thinks pretty or goes with a certain outfit, down to a 13-year-old girl spending their first pocket money to buy something might also go to Lavisa. So huge appeal there. I think that's also one of their massive advantages. And also the transaction sizes are just right for like an impulse purchase as well. It's not, big ticket items like your car or your $1,000 suit or something like that could be more impacted by how much spending money people have, but it takes a lot before someone has to skip on the $25 earrings or whatever it is, or it even could be cheaper than that. But
Claude, where they're opening all these stores? Because I know at one stage they were in South Africa and obviously Australia. Which other countries in the world? Is it around the world?
They've got a bunch of stores that they're planning in Europe as well, although they haven't really, cracked it there yet. They failed in Spain and left there, which is actually a good sign that they don't keep on going when the competitive environment's too difficult. And actually, to get the details of all the countries, I'm just trying to look it up quickly, but you'll have to look at Raymond's report on Lavisa. So if you just Google why Lavisa is a rare gem of an ASX retail stock, that's what we were publishing on A Rich Life in July, before these results, actually, before that nice big candle. And that's not me. That's due to Raymond. That's his favorite preferred retail stock on the ASX, and I think, that's what I agreed with, and we've covered that. And I still agree with him on this one. It just looks a little bit too expensive to me now, but I'm the guy that didn't buy it when I should have. So, that's the original coverage we have, and then we have the actual results coverage, and that's free to read anyway. So,
and Raymond,
I recommend that.
It's another part of obviously the Rich Life team, and what you've got to do is just Google why Lavisa is a rare gem on the ASX retail stock.
Yeah, even just a rare gem, it'll come up for sure.
And read about it, and it's very.
He kind of gets into the competitive positioning and shows that he thinks basically there's plenty of room for Lavisa to grow. They just need to find those markets where they're not already absolutely smashed with competition, because as you can see there, there is competition, and there always will be in retail.
Brilliant. So one of these stocks that we definitely a little bit of a pullback in the markets, get it around 18, and if you can hold around there,
I think the actionable insight at this point is that this is a high quality retailer, and that's pretty clear now. It's had quite a few years of operating history. Dave and I were looking at like the really long term chart, the really long term story there, and like in the long term chart, just buying the big dips when there was big market sell-offs has always paid off for Lavisa shareholders. So can be volatile. Retailers always can be, because they have a lot of operating leverage. They've got fixed costs. Revenue goes up, massive profits. Revenue goes down. The profits can drop more than revenue.
Brilliant. The next one on the list is ALC, and I know we've sort of technically on the charts it's sort of just holding up, right? And we did have a little flirt on this around here as a little bit of a recovery play. The idea of looking at a stock like this and saying, we're going to buy it in the dip. I mean, is it really in the dip now? Are you interested in this around 15 cents, or do you really want to, or do you want to look for it to get back to 10 or 11 cents?
I like it around 15 cents, and I bought it around 15 cents. And that is probably, to me, that's less than $200 million market cap for a software company in a favorable industry, which is healthcare software. These guys are rolling out and supplying UK and Australian governments, also I think a bit of New Zealand. So there's always some sort of oligopoly when it comes to supplying governments, because you need to get on like the sort of approved panel and that kind of thing. So for example, other companies that might be more expensively priced and can't, they might be targeting more private healthcare systems. So they're kind of different, and often the suppliers to the different systems are different because there are different priorities. So these guys have done really well in the public market when the government buyers are there. And essentially right now, there's nothing going for them in terms of the market's current zeitgeist, due to the fact that the market really wants to see profits left, right, and center. It's completely losing patience with companies that are losing money, of which Alcidion is one, which is why I think it could get even cheaper. And even though I have bought some shares already, I'm sort of thinking of that as me starting my process of my most likely averaging down. And look, I've been doing it a while. I liked this company previously, and I held it pretty much all the way down from its heights, because I've held it for a long time. I think I've sold in and out of it over the years, but I think I first bought this at like under 5 cents per share. So from my perspective, on a long enough timeline, actually this company has really built itself up in front of our very eyes over the years through a combination of acquisitions and organic growth. Gross profit of 29.5 million. Unfortunately, costs at the moment of around 35 million. So you've got a loss of almost $4.5 million. Having said that, it's actually not as dire as it might sound, because these guys can get paid in advance oftentimes. So they do have unearned revenue of 12.9 million, i.e. money that they've received, but they haven't done the job yet. But yeah, they're going to be able to do the job. They've got the software. They've just got to deploy it and run it, which isn't too expensive for them. So no worries there. As a result of this, they're actually free cash flow positive, excluding acquisitions. Now that's important, because it means that it's very unlikely. It's looking you'd almost say won't happen, but never say never. But 17.3 million cash, no debt, cash flow break even. These guys saying they're going to head towards a bit to break even in FY 2023. I would pray that they actually make a profit, because I think that's when the market will start liking them better. But yeah, look, I own it and I like it. And I think these ones could get dire, because they're loss-making, small cap, they're out of the index, they can easily get neglected and smashed down during a panic. We saw it get almost to 10 cents. Probably 150 million market cap. Again, almost 30 million gross profit. That's not bad for a software healthcare company. It's probably going to, anyway, good growth on the last 5 years, and let's see what it achieves in the next 5.
So if it gets down near 10, 11, are you filling your boots?
I would definitely be looking to buy this if it hits. I was waiting for about 10 cents before, and it struggled and just touched 10.5 cents, and I end up paying smaller, but just buying a smaller number of shares. So definitely I do continue to like this around 10 cents. I think that it will reach profitability without needing to raise capital. And I just think that it's an attractive business model.
You made one of your greatest calls, which when you were Motley Fool, which I think really set Motley Fool, really helped Motley Fool at the time, and I think that was PROMEDICS. And you can see how volatile even little PROMEDICS was in the early days, up and down.
Yeah, that was before I even got it. And then it was like at 86 cents that I started buying. Finally got it on the scorecard of Motley Fool at like $1.50.
How similar was this story at the time to what you see in an ALC now?
It was a little bit better of a story than ALC, because PROMEDICS had a track record of having been able to make a profit. Also, PROMEDICS had a slightly better ownership structure in the fact that its founder had just come back as CEO. The two founders controlled the company. So there was probably like slightly better alignment there with shareholders. Now, the Alcidion CEO does own a bunch of shares, so I'm not saying it's bad on that regard. But, yet PROMEDICS was a slightly better setup. Its enterprise value was smaller when I started seeing it. So Alcidion's like 180 million, something like that at the moment. I think when I started looking at PROMEDICS, it was like under 100 million. Even when I recommended it was like it was about under 150 million. Plus they had a bunch of cash. So enterprise value of around 100 million. It was looking pretty good. Slightly better overall setup than what I'm seeing with Alcidion right now, but probably more analogous to what you would see if Alcidion was like 10 cents per share. I feel like it would be a similar kind of quality of the likelihood, the odds are in your favor because this company just needs to keep growing revenue and probably the profits will come. Now, the risk with Alcidion is as we didn't know it beforehand. For all I knew, PROMEDICS would be like so many other companies. As its revenue went up, it just would rise its expenses even faster, and you'd never see the growth in the profits. As it happened, these guys didn't do that. And that's always the risk with Alcidion because we haven't seen that track record yet. We don't know for sure that this is the kind of board, this is the kind of CEO that actually does have the wherewithal to control expenses and let that revenue keep growing and do that really beautiful thing where the profit just explodes. But she's done a great job growing the revenue so far, and she has been moving it towards profitability. Although actually its most recent results actually saw a lower profit. The cash flow discipline has been there. So yeah, look, it is definitely a milestone when a company has now 2 years running had free cash flow excluding acquisitions. So that makes you think that they've got control of the funding if they can manage to keep the cash flow positive. And look, they are saying a bit will be better this year. They're not anticipating acquisitions this year. So that was going to save them a couple of million in costs there. I think that they're going to probably just make a smaller loss in the next year, but in the year after that, it would be very reasonable to expect a profit. And then once you get your first profit, if they can just control expenses, that's when you can add in, they increased revenue by, what was it? About 9 million or 8 million
up
in the last year.
Yeah, up 33%, I think.
Yeah. So if they can just hold expenses and increase it by 8 million again, they would be profitable next year. Now, I'm not saying that will happen. I reckon expenses will go up a little bit. So it'll probably be closer to break even next year, but you can definitely see how it could scale well. It's the right kind of business model to scale well. Like definitely. They keep selling the same bit of software, right? So they don't have to go and do everything again every time they add a new customer.
And so 2 exciting stories so far, Vista and ALC, if we can get them in a decent pullback. Now, number 3 is M7T. That's, I think it did have a pretty good report recently. It's just been in a downturn really since it broke trend up here at 110.
Yeah. So this one is a very similar story to Alcidion. It's in the same area. It also does, so it's more of actually a competitor to PROMEDICS, but it competes in the low end of that market. So PROMEDICS has the really good top-notch clients who pay the highest possible prices because their software is the best. These guys are again competing for less attractive customers that I guess have pricing as more of an important factor in their decision of which software they use. And similar scale to Alcidion. So basically, it's actually a very similar story. It's actually probably both of these companies have a mixture of recurring and non-recurring revenue. So they're not as high quality businesses as PROMEDICS, which is almost completely transaction based, does have a little bit of one-off stuff. And very similar story, except these guys have 27 million of revenue, slightly less than Alcidion. They have a similar size loss. But that loss has improved greatly. So they're sort of heading in a slightly different direction. And again, the thing that makes these guys investment quality, in my opinion, is you have this dynamic where they can get paid up front. So their cash flow looks better. So basically they get paid and then they can use that money that they get paid to do the job and to pay the people that they need to pay. It's a good, attractive business model because it reduces your need for working capital, which is super important in an inflationary environment. You see something like Dicker Data, which I own shares in, everything's going well, it's growing. But as it grows, it needs to hold more inventory. As it holds more inventory, it needs more money. So it's raising capital, raising money just so it can afford to grow because it needs to have more access to more funds in order to grow. These guys don't have that same issue necessarily. So all in all, yeah, interesting one. Not as good as Alcidion, in my opinion, much more checkered history. And So I only have a tiny holding in these, but that holding does signify my intention to potentially buy more if the share price does come down.
And the market cap is slightly less than Alcidian. It's 156 million, I think, at the moment.
Yeah, it's slightly smaller.
And would you be looking to sort of down near that 50 cents where it went before? Would that be a sort of...
Yeah, look, I did it again. Like it was like 45 cents. I think it got down to at some point during the sell-off. And that's when it was really catching my eye. And I was like, oh, I think this is too cheap. And I was look, I made the mistake. I waited for the quarterly result to come out. Actually, that quarterly was quite good. And that's why you see that green candle there where it bounced up on its quarterly. And I bought after the quarterly.
It's funny, isn't it? It just couldn't quite get above the water level trend. It actually just stopped right on it and hovered around that for a few days. And yeah, I think it's just the market sentiment just wanted to go.
That's less than 1% of my portfolio, that stock. So just should be, flagged that I'm not high conviction on it yet. Alcidian's only a bit over 1.5%. So neither of them do I see as being like really ready in the perfect setup right now, but they're definitely in the zone where I want to watch them.
Brilliant. Listen, that's 3 really interesting stories and they're early days, but we want to take advantage of this pullback that we're going to get in September, October. And, and again, it's exciting times. So those 3 stories, ALC, M70 and Vista, well worth having a look. Just broadly, there's some news today. A2 Milk sort of poked his head up and I think they had a announcement today, and that announcement, I had a brief read of it. It was the SAMR registration, which I think they've been given till now 2023 to sell their product in China. The only issue is the Chinese are very good at always keeps them on the hook, isn't it? Apparently they've got to go for another process and check they've got to check their contents, so exactly what the Chinese want in their milk, and before they get another license. It's frustrating, actually. It's very hard working in China and selling products in China because the Chinese always like to have their sort of thumb on your head, don't they?
And also they just change the rules whenever they want. It's like it's not, at least in a democracy, like crazy things can't happen quickly. Like there has to be some debate over it and people talk about it. In China, they don't have any of that. Oh, we want to transfer profits from an Australian milk company to a Chinese milk company. Easy, do it.
Just have a look. Obviously, LEL, they're starting to drill, and I think I had these on Einstein's. The share price looks very, very good. But lastly, the last stock I just want to talk to you about was AJL Lucas. And it's talk about being in the right place at the right time, Claude. They've got on 2% of basically the land area in the UK. They've got huge swarms of land for fracking rights in the UK. Now, I read over the weekend there's been amazing valuations on these fracking rights up to I won't actually say how high they are because I don't want people get carried away, but in the billions and billions of dollars higher, obviously sort of than what their market cap is. What's happened is that because of these, I think energy prices in the UK have gone up 400%. People are really struggling to pay their energy bills. The UK, the new Prime Minister of the UK, she's come out and basically she's opening up all these sort of reinstating the fracking rights for AJ Lucas. Now, since that's happened, the share price has doubled, and the share price is, is around 300 million. It's most probably around 400 million now. It's just a trending stock or a trending idea because we do see possibly a year from now or even 2 weeks from now, like there could be tremendous, I don't know, tremendous, how do you say, resistance to fracking, giving fracking rights in the UK.
Yeah, I think sociologically there's a trade right now because there's like always making money in a trade. It's all about something changing and then the market pricing representing that change. Previously, these guys had no chance to develop these assets because there was no reason to do it. Massively inconveniently for the people that live around where they want to frack. They're going to have earthquakes. They're going to have poison water. They're not pleased about this idea. And obviously there was no reason to do it, but now they've got desperately need more gas. You know, Great Britain wants to get some gas for itself, wants to increase its own ability to mine gas. Suddenly this has become more important. So there's a change. And that means that a new story takes hold, which is that these guys are going to be able to develop these gas assets, blah, 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 make heaps of money, etc. And then people might start being like, all right, they're going to do it for 20 years. They're going to, it's quite likely that this story might get taken too far at some point, and people will believe too strongly that all of this is going to happen. And it might look like things are going to happen, but then if the gas prices change, it becomes less attractive, and there will be a pushback. There will be a fight every step of the way, because there's other people who have money on the line as well. They own property that's going to be massively devalued. So it's not a pushover. We've seen in Australia what happened to like Metgasco and Titan Energy Services, where they were going to frack. The market's like, yeah, you're going to frack, get all the gas, make heaps of money. In the end, no. Actually, what happened is they couldn't get the drilling truck to where they needed to drill because all the people blocked the road. And then they bought back the tenements. So I'm going to see what's going to happen. But right now, the story's favorable. The change is in favor of this company. So that's why it's interesting from a sociological perspective. And that's what you're trying to trade.
Yeah, definitely just a trading stock. And they say they've got enough gas to supply UK gas for over 50 years in these fracking wells. It's huge amount of gas they've got. And the valuations are obviously a lot higher than the present market cap, but there's huge risk on it. But I think I think when you get some good news, you tend to get more good news that tends to follow. And I think that good news, you know, whatever good news we get that follows, I think we could see this trend higher over the next few months. On that note, Claude, thank you so much for coming on and giving us basically 3 stories to buy when we get this pullback. Thanks for obviously your opinion on AJ Lucas. Any more words of wisdom before you go?
Nothing right now. I think we're on the same page that right now is, you know, I'll just say this. Right now, I'm going to be working this week on making my list of, you know, stocks that I want to buy during a pullback. And look, if we don't get the pullback, that's not going to matter. I'm still invested in the market. But if in the case that we do, I want to be ready to try and take advantage of it little by little.
Brilliant. On that note, I'd like to thank the great Claude Walker, absolutely brilliant analyst, for all his advice today. And have a good day, Claude.
Yeah, thanks for having me. Have a good day. Thanks for listening, everyone.
See you, champion.